Hello, and welcome to our next installment of the 8-Minute Update, along with our continuing theme of Protect, Prepare, and Recover. I'm Chris Walker, and I'm joined again today with Roberta Angelo, Vice President of Client Relations here at Freedom One. Today's topic is active and passive fund management. At Freedom One, we really have two primary investment responsibilities. The first one is asset allocation. Our job there is to go through and to allocate the portfolios amongst different mutual funds, among stocks, bonds, and cash.
Okay, so like with the managed account portfolios, you would have a different allocation for a more conservative portfolio versus a more aggressive portfolio.
Absolutely. And the way that we would implement that is with a more aggressive portfolio, we would have more stock mutual funds in it and less bonds. And for a more conservative portfolio, we would have more bonds and less stocks, hoping to achieve the investor goals. The second job we really have is fund selection. And that's really where the meat of our job throughout the year is done. What we'll do is we have to determine the proper mutual funds to put into the maps. The way that we do that is we start by researching a whole host of different funds. There are literally thousands and thousands of funds out there, and our job is to find the very best that we can to meet the goals of the investors. We do that by doing statistical analysis. We'll go out and we visit with managers. We have conference calls. We go out to different conferences that are held throughout the country to make sure that those mutual funds are the best of the best. We need to know not only how the fund operates, but how the fund manager himself operates, he or she. After we do all of that work, we'll come up and we'll select a few funds that we think are the very best. Our job then is to monitor those funds going forward. Some of the more important things we do is we determine what types of funds. There are really two broad categories of funds. First is active and the second is passive. A passive manager is someone that doesn't make investment decisions directly. And I think we've got to talk a little bit about what a passive manager is. What a passive manager does is they follow an index. Now, let's talk about what an index is. I'm sure everyone has heard of the Dow Jones Industrial or the Standard & Poor's 500 or S&P 500. You hear about those in the evening news. And they say that the stock market went up or down. So those different indices are very important in how we manage the portfolios.
Yes, I think everybody's very familiar with the S&P 500, and most people know that that index tracks the 500 largest domestic stocks. But maybe you could tell us a little bit about what the Dow Jones tracks and what the Russell investment indices track.
The Dow Jones, which is one that you hear about in the news quite a bit, is actually the oldest index around, and they hold 30 different stocks in that. And those stocks change as the economy changes. The Russell investments, that really what that company is designed specifically to do is to create indices. So there are quite literally dozens and dozens of Russell indices out there. Some of them will track international stocks, some of them will track domestic stocks, some small cap, large cap. So the Russell is a very useful tool for us when we go through and review our portfolios. So why would we use, or why would anyone use an index? Really what it's to do is to provide some broad idea on where the market is going. So if you hear that the indices, the Dow Jones Industrials, the S&P 500 went up today, odds are your portfolio went up some percentage of that. The second thing that used for is benchmarking relative performance. If the stock market, if the S&P 500 goes up 10%, your portfolio should go up somewhere up or down relative to 10%. We want to make sure that depending on how aggressive or how conservative we invest the portfolio. Next is it gives us guidance on the construction of the portfolio. For example, back in 2000, there was an awful lot of money that was into technology stocks. A year ago, there was a lot of money into financial stocks. We want to make sure that we don't invest too much into what might be the hot area of the market, that we want to control that risk, which really gives us to the last point here. It gives us insight into portfolio risk to make sure that the way that we're investing in your portfolio best has the opportunity to give us success. So that's why you would use an index, but the question then begs is how do you get that index into the portfolios? There are mutual funds that are created specifically to track an index. For example, one of the ones that we use in the portfolio is the Vanguard 500 index. That tracks exactly along with the Standard & Poor's 500.
Yeah, I noticed your chart isn't really all that exciting. You've got two colored lines that pretty much overlay each other.
That's somewhat the thought. That means that Vanguard is doing exactly the job they're supposed to be doing, is that although it would be impractical to go through and invest in 500 individual stocks ourselves, by virtue of buying the Vanguard 500, we actually get the exposure into those different stocks. Next is, why would you use an index fund? This really allows us to conveniently go through on a cost-effective manner to invest in exactly the way the market is performing. So there's a great use in having index fund, and we actually have a number of index funds in the maps. Now this gets back to where we originally started, is this active versus passive. What an active manager does is that you have a portfolio manager that takes their expert analysis and experience and creates an individual portfolio. Now the hope there is that they will get returns in excess of the general market. An ability that they have that a passive manager, an index doesn't have, is they can go through and react to different market conditions. So if they feel that it's time to have more cash in the portfolio to mitigate some of the risk, or if they want to get very aggressive, that's what an active manager does. A passive manager, on the other hand, really has a very simple job. What they do is they look at the components that are in, for example, the S&P 500, and they buy those 500 stocks. So there's really not a lot of thought that has to be put into it. It's more of a computer program than it is anything else. The advantage there is you're not paying for all that overhead, so it's very low cost. There's market efficiencies from the standpoint that you get exactly the return. For a taxable investor, there are some tax advantages to that, but I realize most of our portfolios are not affected by taxes. You have consistency of performance. You get exactly what it is the general market does. And finally, there's no manager risk. That's actually one of the jobs that we have to do when we review active managers, is to make sure that the manager is exactly the person we hoped it was. You really have no manager risk in passive management.
So it seems like the passive management type funds are much simpler, and their job is to track the index, but the active managers, their job is to beat the index. Was that fair to say?
That's not fair to say. That's absolute to say. That's exactly what it is. And for example, we talk here about the cost advantage on the Vanguard 500. The typical fee on an active management is somewhere around 125 basis points, or 1.25%, where on the Vanguard 500, that fee is less than 0.1%, or 7 basis points. So the savings is much more dramatic on the passive management.
So you've mentioned the Vanguard 500 a couple of times. I think we have 3 index funds. Is that correct?
That is true. What we do is we have the Vanguard 500, which tracks the S&P 500. We have a Columbia Midcap Index, which goes through and it tracks a Russell index. We talked about Russell when we started. And then finally we have the Vanguard Total Bond Index, which actually the first 2 we talked about were stock indices. This one's actually the Vanguard Total Bond Index tracks the bond portfolios. As I've mentioned here, we have both active and passive managers. So we actually have blended the two. The reason that we've blended the two is that by blending both active and passive managers, we have less volatile returns. Hopefully that long-term that gets to investors' goals. We control missteps by the managers, because managers are constantly changing these different mutual funds. And so by having a little bit of passive and a bit of active, we're able to take out some of that manager risk. As I just talked about, the expense ratios, the expense of having these portfolios, the passive portfolios, is much, much less than an active. And by blending the two, we get some consistencies in the markets.
That makes complete sense.
Well, that's the end of today's 8-minute update. Look forward to the next one, which will be on May 21st. And there we're going to talk about the different bond managers and the way that they work together. So once again, thank you again, and look forward to the next 8-minute update.